Hey everyone, and welcome to Talk ETFs. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. So today, the Fed just hiked interest rates for what could be the last time this year. But what should investors do? Should they be buying fixed income ETFs? And if so, what should they be buying? The Fed potentially being done with interest rate hikes doesn't make life as a fixed income investor any easier. If anything, it just raises more questions. Fortunately, I have Steve Laipply, who's the head of US iShares fixed income ETFs, here with me to answer those questions. Welcome to the show, Steve.
Thanks for having me.
So, Steve, the Fed has pushed interest rates to around 5%, which is the loftiest level for the federal funds rate in around 16 years. Do you think these high rates are going to stick with us for a while and we're in this higher interest rate paradigm? And if so, what should investors do about it?
I do think we've entered a new paradigm. It has been many, many years, to your point, as far as having rates at these levels. So if you go way back to the financial crisis, in order to try to grow the economy after that, the Fed had to keep rates near zero on the front end. They engaged in quantitative easing, and that kept rates down across the entire curve. Now, all of a sudden, investors are confronted with fixed income as an asset class, which is something that they're not used to. Being able to actually get income from fixed income. And so if you think about what investors have been doing over the past many years, they've been forced to go down in credit quality. They've been forced to take on more risk, whether that's duration risk or liquidity risk or what have you, in order to get yield. And now they can do something as simple as buying a treasury floater, which has almost no interest rate risk, and getting close to 5%. So yeah, it's a new paradigm.
I'm glad you mentioned that, Steve, because short duration fixed income ETFs are yielding a lot. Floating rate ETFs are yielding a lot as well, but long duration fixed income ETFs aren't yielding as much because the yield curve is so inverted. Does that mean that investors should stick to the short end, or where do you see the opportunities?
I think it depends on the investor's risk tolerance. So we believe that the long end also still plays a role, which it's getting back to that traditional role of ballast in the portfolio. So last year was a very interesting year where you had correlations sort of upside down where everything was selling off. So fixed income wasn't playing that traditional role of helping to offset the riskier assets in the portfolio. And now we're at rate levels where it can play that role. So we're back to a situation where you're getting income. And on the long end of the curve, you're able to diversify your riskier assets like equities. So if equities sell off, what we've been seeing lately is a reversion to that more normal correlation structure where you'll get ballast from fixed income.
We are seeing a huge amount of inflows into fixed income ETFs this year, and I'm noticing that your ETFs in particular are seeing an enormous amount of inflows. I noticed a number of the iShares Treasury bond ETFs have seen billions of dollars of inflow since the start of the year. What's the reason for that? Is it the regional banking crisis or something else?
It's continuing a trend from last year. So if we go back to last year in the US for iShares, we took in over 100 billion. Something like 60% of that was in treasuries. So this quality trend, this desire to go up in quality has been intact over this entire tightening cycle. And so you saw investors last year allocate to treasuries and investment grade. And they were pretty much, surprisingly, across the entire curve, so not necessarily sticking in the front end. You've seen that sort of continue into this year. I do think it's been tilted more towards treasuries because of some of the volatility that you've seen, which is kind of the classic flight to quality thing. So, we've taken in around 26 billion year to date. On a net basis, about 25 of that is actually treasuries. But again, interestingly, just like last year, it's spread throughout the maturity spectrum.
So everyone obviously pays attention to the big names, the IEFs, the TLTs, the SHYs of the world. But are there any other iShares fixed income ETFs that are seeing a lot of demand?
So I mentioned our treasury floaters, so TFLO, which we call TFLO. We also have a very short dated treasury bill product called SGOV, SGOV. Those are also seeing flow. So for that investor that wants to take advantage of where rates are on the front end of the curve, that's a good way to play it while still minimizing your duration risk. And then, of course, we've got the other asset classes as well, which right now I think investors are holding back a bit from credit, particularly high yield, and they're waiting for things to kind of calm down a little bit here.
And obviously, this year we have some special circumstances that are driving inflows. But as you look ahead 2, 3, 5 years, do you expect that bond ETFs are going to continue to grow as an asset class?
Actually, we were predicting that they would hit 2 trillion globally by 2024. I do think we're on track to do that. And that's despite a huge mark-to-market shift, negative shift from last year because of rising rates. So despite that, we're still on track, I think, to actually hit that 2 trillion mark. And then we're predicting we'll hit 5 trillion globally. And that's across the whole industry in both cases. But we'll hit that 5 trillion, we believe, by 2030. And I would not be surprised to see that on an accelerated timeline, simply because, again, what's different now is that you now have yields in fixed income, and investors are very excited by the possibilities of reconstructing the way were building their portfolios. So if you think of a 60-40, the 40 is now meaningful again. And so we think that element is going to accelerate flows, if anything.
So, Steve, of course, the demand for fixed income ETFs has been growing for many years now, but can you talk about who is buying? Is it institutions, retail, everyone?
It is everyone. It's across the board. You know, we talk a lot about retail or wealth investors, individual investors. They do make up a huge portion of the flows, and they tend to be more buy and hold investors. But an exciting dimension of this, which is great for the liquidity of the products, is the uptake by institutions of fixed income ETFs. So we first saw this during 2020, during the COVID-induced volatility. Around February, March, we saw a huge surge in institutional adoption. I think that particular period showed that the bond market still was facing some liquidity challenges. And so whenever you have those periods of high volatility, that tends to show up. So we had institutional investors, some of which for the very first time turned to fixed income ETFs to navigate that very volatile period of February and March 2020. That's kind of continued apace. And I think last year, we had a different sort of volatility with the tightening cycle and quantitative tightening kicking in. And that induced another wave of institutional investors to start incorporating these products, because most recently, even treasuries have seen some challenges, especially in the off-the-run security. So again, across asset classes, and across sectors in fixed income, more and more investors are realizing that these products need to be part of the toolkit for liquidity, risk management, and just investment outcomes.
Finally, I want to ask you where you expect to see new innovation when it comes to fixed income ETFs. Are we going to see it in active fixed income ETFs? Is it going to be in some segment that we haven't touched on yet? What do you think?
I do think that you are seeing more active fixed income ETFs. That is the part of the market that was seeing a lot of interest from sponsors, but now it's starting to see interest from investors. And so I think there is a demand, and this is part of the longer term trend with the wrapper itself. There's a demand to have active strategies in an ETF wrapper. And so I think you're going to see more and more of that going forward. Other aspects of innovation that I think you'll see, and we've brought some products to market which illustrate this, is more what we would call defined outcome. So we launched last year 3 products that are traditional buy right strategies, but in fixed income. So they were the very first fixed income buy right strategies. And what is that? That is, you own the underlying ETF, but you sell call options against it for additional income. So we launched those products off of our 3 big flagships: LQD, which is LQDW, HYG, which is HYGW, and TLT, which is TLTW for the buy right part of it. But those products are up to nearly 200 million already. So there's a lot of interest in seeing these types of tailored outcomes.
Well, Steve, a ton of great information. Thanks so much for taking the time and sharing your insights with us.
Thanks for having me.